Chart Watchers, it's Greg Schnell, and I am here with the weekly market roundup for March the 8th, 2019. What a week it was. Nothing I was happy with, actually. Currency moves were big. US dollar made a new 20-month high. The euro broke down, which we had been expecting for a couple of weeks. But the world had a bad week, but it's where on the charts the world had a bad week that matters to me. And we're going to talk a lot about that because if I was to set up a risk scale, I would say this was, the epicenter of the week. This is where we would expect things to really kind of last gasp if it was going to roll over. And so to have this weakness and the size of the weakness we had, where a lot of charts made outside reversals, pretty darn concerning. And I want to continue to be cautious with oil. The precious metals tried to rally on Friday. Well, they did rally on Friday, but the question is the US dollar was also sitting at 20-month highs, so how that resolves itself is important. Agriculture was horrific this week, broke down to new lows. Charts like Nutrien look like they're ready to have a bad couple of months coming up. And hold your breath, keep stops in place. It's not the end of the world. The trick is we're on a very high peak and we can look both ways from here. And I think the real critical stuff is going to come up. On Friday we have quadruple witching, and the week after that we have the Fed meeting. And so in the next 10 trading days, I think we're going to have a lot of results come out that help us figure out the direction of this market. So I'd say it's all hands on deck, but that doesn't mean get net short or anything. I just think it's really important that we take the time to be aware of just how fragile things are. So first of all, I want to start with the advanced decline line. And of course, the NASDAQ is up here on the composite. And what we see here is it tried to rally back up to prior highs. It's got stuck here at November. The advanced decline line actually rallied slightly above it, so there was a lot of us starting to be a little more bullish on that. The thing is, this whole mountain has been slowly finishing up here, and now we declined down. And the question I have is, we were already down to kind of a normal pullback level. Is this where we end? And again, the McClellan oscillator is oversold, so this would be a great place to expect a bounce. The question is it a rattle this week and then a real drop with the Fed meeting after, or is it a rattle this week and then we rebound and start soaring on the back of quadruple witching and the Fed meeting? So I'm expecting a sideways week, or a week where we get ready, and then the real question will be which way the market wants to break out. So that's kind of what is in store for me. Here's the high lows. So that was the advanced decline line on the previous chart. This is the high lows, and here's the issue. We go along here and we have trouble making a new bull market back in 08, and we rally up and then we fail, and then we rally up and we fail. And the real question is, do we have enough to get out of this kind of doldrums? So back in 2014, 15, 16, we went into this period where we really couldn't get rocking, and then we tried to get rocking and then pulled back. And then on this low, it was a nice low to actually buy and get long on. But we had quite a bit of rally and then a pullback, and then we really started to get a lot of net new highs, and that is critical in our next step. If we don't get a lot of net new highs, then I'm very, very concerned that this market will roll over, because we're already back below net new highs, down below 17 or negative 17. So that means we had more lows than highs. That is a concern with this bigger rally. So new 52-week lows. Okay, here's the advanced decline line for the New York Composite. And I just want to talk about some 4 simple points here. So here is the September time frame. And what we see is we made a higher high on the Fed meeting day back in September. It might have been this might be the options expiration day on this Friday right here. So we went into this meeting into this period, and we topped out, and then what happened, we actually made a lower high on the advanced decline line. And then as we came down here, we actually started to make new 1 month lows on the New York Stock Exchange. We had already done that the week before on the advanced decline line, and it was starting to break down, and then we meaningfully pulled back. Here we are at 3 week lows, and we're kind of similar to the market here. And the real question will be, when we rally back up, do we get as much advanced decline line participation? So that's what I'm watching over the next 2 weeks. New York high low. This one's the same problem. You can see in 2018, so we had a big bull market, then we really wiped it out. Couldn't get a lot of momentum going. Same back in 2014-15. And you can see in 2015, in that October-November period, we got up right up to around 100, rolled over, and then started breaking down again. We are doing the same pattern on the market with that kind of trade, so that's got me concerned. Now, here's the good news. We actually got a little higher than we did back here last October, but marginally. We just got back to where we were in the 2018 timeframe. And so the concern would be, as the market rallies here next week, if we don't get a lot of new highs, especially on the New York, I really want to be concerned about that. I would say the one thing that we got here was this big, this is a moving average of the new highs, and we got quite a sudden surge, whereas back in October of 2015, we just didn't get that sort of breadth and improvement. So I would say this leans me to be bullish. The fact that we're testing zero right now is a pretty important level. Whatever, I think we wander this week. I don't think we scare the chart either way. I think after quadruple witching and the Fed meeting next week, we're gonna have more work to check out. The candle on the Shanghai was ridiculously bad this week. We had a big push to the upside, and then literally, not only did that not hold, we didn't hold last week's close, and we closed below it, and we closed on the low of the week. So in terms of an exhaustion move, that pretty much tells the tale. So that's quite concerning to see that. If this week we continue the road down on the Shanghai, that would add a lot of caution to me for the Chinese charts. And I have a whole bunch of reasons for liking the Chinese situation right now. I mean, this breakout is really good, and a small pullback wouldn't hurt. The big issue is, of course, if we just unwind the chart a little bit, and if we drew a line of where we'd expect resistance, let's just pick 3,100 or 3,000, something like that. Just put on a horizontal line. It doesn't really matter what color. What we're going to see here is this horizontal line. We basically tested it, failed, and pulled right back below it. So if there was a place to kind of test support and resistance, this week was it. And the ugly candle, as we did that with a PPO right at zero, is really defining to me, and not at all comfortable that this resolves itself well. So 1 week doesn't make a full wholesale change in the market, but it should definitely tell us to stand up at attention and pay attention to what's trying to be told here. I think if I didn't tell you which market this was, and you just saw something that was making a shoulder, another one, rolling down and really starting to get weak, and then it rallies back up and starts to fail in line with some of these support and resistance levels here, most of us would expect that this market would pull back as technicians. So I am really super concerned about the level that it's trying to fail at, and I mentioned that in my opening slides. Was just, it's not the fact that it's struggling this week, it's where it's struggling this week. And the problem is we've had such a sudden advance. Many people will call that just a bull thrust, but it can also be this sudden enthusiasm to keep up because the market was really, really good and everything should be really, really good, so I want to get back in. And literally a lot of people who were too afraid to buy at the bottom were buying at the top while institutions start to sell to them. So this is a really important level here, just the fact that all of this was a support level back here. And so as it gets up near there, what people tend to say is, oh, good, I've got almost all my money back. I'm going to sell right now. And at least I'm out near near whole, so that's good. The problem with that is obviously that creates selling pressure at the top of the market, and the longer we spend here, the harder it is to get through. So that's one of the reasons I'm concerned. And this is the Canadian stock market. But the big issue is just this structure, and then where we pause, right in here, right where some of the largest levels of concern would be, is exactly where the market has stalled. Okay, so here's the high-low for Toronto. Same issue here. We're going like a year and a half where we just can't get more than 50 net new highs in the market. Now, we can rally when we're above zero, but you can see how fragile this is when we're back at zero. When we don't get above there, that's typically where the market starts to top out. And that's what makes it more concerning. And you can see even in the Canadian market here, we rallied up and then pulled back very quickly. And when we went below zero, that was a place to be cautionary. We stayed down here for a couple months. Got a little bit of enthusiasm above zero and then rolled back over, and you can just see this big decline that we couldn't make more new highs. And so that gets more and more concerning. And this downslope obviously is a problem. And here we are just struggling right at this red line. That was not new this week. That line's been there for a while. So anyway, the Canadian market suggests caution, and I think the Canadian market's one of the good places to look for U.S. investors because in general it's weaker than the U.S. market, so it usually kind of gives a clue first. I'm just going to delete this chart because I want to talk about the bonds all together at the same time. Okay, so here's the McClellan oscillator. We mentioned this last week that we're at a super high level, and this is rolling over. Now, that doesn't make it an immediate bear market, but again, we're struggling at resistance right at a place where we would expect it. So we have a high, a lower low, a lower high, a lower low, a lower high, a lower low, the same sort of high, and now we're wondering, do we end up with a lower low? And as you get farther into a bear market, what happens is the rallies are steeper and the sell-offs are steeper. So if this was going to start to accelerate down, that would be problematic. Now, I noticed this period here where we had such big enthusiasm, and then even as the McClellan oscillator pulled back, the summation index kept going, and until we got to this zero level, then it actually started to roll over. When we go back and look at some of the other market cycles like that, it's not uncommon to get that sort of condition and then end up in a bit of a pullback in whatever, 2 weeks, a month or something, before we start rallying again. The real question is we also see this sort of condition in a bear market. So it is not just a one-way street. Here's the summation index using a Renko chart or candlestick charts up here at the top. And what you see here, weekly candlesticks, is we've rolled over now. And, just if you ignored everything else on this chart and I just showed you a stock that was in this sort of a trend, I'm pretty sure most of us would have trouble holding right here, right now. The fact that it's an index adds more stability, but you can just see that typically when you get these rollovers, this is a concern. And the New York Composite I find to be a pretty good clue, better than the NASDAQ actually, to weakness in the market. And the reason is, you can see in October here, it did not make net new highs, or it did not make new highs, whereas the S&P did. But this market was kind of showing the underlying weakness, and it was having trouble breaking out. So here we go again, and it's having trouble breaking out. I wouldn't ignore this clue. I think it's pretty important, and at least it's a clue for us to pay attention. Okay, the summation index here, same thing. We had this nice ballistic move, and the rocket seems to be stalling a little bit at the top. Look at how small the box is. Again, you can get way up here, so let's just say it's to the left of this vertical line. Come down here, no big deal. This continued to rally for another 6 months. So it's definitely not a given that this market's going to decline hard. I still think that the problems are overseas, and that's what drags down the U.S. market. The bullish percent indexes gave a lot back this week. This wasn't so much on the NASDAQ Composite, but look at the percentage of stocks above the the 200-day moving average. This gave back almost 10% in a week. So the difference between a bullish percent index and a 200-day is this 200-day level is literally a line in the sand. You're either above it or below it. In order to change a chart from a bull market to a bear market, or not a bull market, it has to actually make a lower low. So after a big, huge move like this, it's going to be very difficult to turn this bullish percent index chart around because so many stocks have a new buy signal. But we still only got 50% of the stocks on a buy signal, even with that huge 10-week rally. And now for it to stall right here at this level, this chart still doesn't look too bad. Just wait till we get to the next few. But my concern is how quickly the percentage of stocks above the 200-day moving average started to drop. So that's really meaningful because I thought after a 10-week rally, we'd be in better shape. So this is the NASDAQ 100, and what you can see here is we went from almost 78 to 62. We lost 15% of the NASDAQ 100 went on a sell signal this week. That's a big deal. So it doesn't just mean it didn't make a higher high. 15% of them actually made lower lows on a P&F chart. That's a really big thing for me. So I was shocked to see that actually. When I got to the chart, I did a huge double take. Okay, so here's the percentage of stocks above the 200-day moving average, and we got up to 64, and only 7% of those dropped below their 200-day. So what that means is a lot of them are well above, and this little pullback didn't matter, but for the average NASDAQ stock, it did. So I think that's a clue. And then the second component here is this very big move down in the bullish percent index. That is a stunner for me. From the New York Composite, again, here we go. And what you see is we got up to this 60 level, and this is kind of where we were at in October, where we got up to 60 level and we rolled over from here. So this isn't exactly a safety level by any stretch on this chart. And you can see back in 2008, this is kind of where the market continually kept stalling up right around this level. Now, look at what happened on the percentage of stocks above the 200-day. We were almost at 60% last 2 weeks ago, and here we're at 46%. So just a huge move down across the broader NASDAQ or New York Composite. And again, it's been a better gauge of when the market is starting to really get weak. So if this level in here doesn't hold, I'm quite concerned that we have bigger problems. Okay, so the S&P 500 is still, this chart's nice and strong. It's still up between my two red lines. That's good. The percentage of stocks above the 200-day moving average went from 64 to 54 in 2 weeks. So 10% gave back the 200-day moving average. I think a bigger issue, obviously, is the next couple of weeks. If we don't start to hold in around this 50% level, when more than 50% are below their 200-day moving average, obviously the market's probably in a bigger downtrend. So that would be the big question for us to watch is over the next 2 weeks, can we continue to hold these levels? Again, from a buy signal on the bullish percent index, this is pretty good. The big thing for me was how weak that NASDAQ one was. So that tells me the tech stocks aren't exactly holding up as well as we might have expected. Here's the Toronto Stock Exchange, and we're still on trend here in a downtrend. We're only at 55% of the stocks are on a buy signal. And we didn't have that much movement in Canada from 58% to 55% this week. So still okay, but you can see in here, this is not a good place for the market to stall. Most of the big declines are below this level. So really important going into next week. The energy sector, first of all, let's start with the price of crude, still holding above the 50-day moving average, but look at the XOP, exploration and production, and oil services stock, both move below their 50-day moving average. That's a concern for me. You're in a big bull market when you're above that on all of these, and you're not when these stocks are failing. So that's concerning, and you can see the bullish percent index has rolled down from 60 to 40 over the last 2 or 3 weeks, and the XLE, which has more than just oil in it, is barely holding above its 50-day. So this chart is pretty weak, and that would be a big concern for me that this doesn't get fixed. I should have updated that table. I'm sorry. Here's the bullish percent energy index. What you see here is we were trying to get a rally off the bottom here, and this is looking like it's going to fail. So I'd be more concerned this is, these sorts of periods in here and not as bullish as I would expect. So I'm on full caution here on oil. If this week doesn't hold up, I think it's a really big deal. Okay, gold. Gold tried to rally on Friday and is on this chart, same idea. Here's the gold miners ratio compared to gold is above the 50. That's bullish. GDX is above 50. That's bullish. The percentage of stocks on a buy signal is still trending higher and above the 50-day moving average. That's bullish. And the only thing that's not is the price of gold. And one of the concerns I have on Friday is gold made a new push higher, and the US dollar had broken out on Thursday and then pulled back on Friday. It didn't give up its breakout. The US dollar made a new 20-month closing high on a weekly basis on a line chart, so not intra-week high, but end-of-week high. And why that's important, weekly charts are important just to see where people are willing to hold over the weekend. So I'm having trouble matching up gold trying to go higher while the US dollar breaks out to new highs. So this is a very cautionary area for me on gold. If you were going to trade it, I wouldn't let it get away. I'd make sure you had stops in place very close. S&P 500, we have quadruple witching on Friday. That's a huge volatility day. You can see all of these big volume spikes happen on options expiration day. And the one in September, I put the line one off to the side, but you can see the actual market top was on the Friday options expiration day, finished on a high, bang, down we went. A couple more options expiration days just closed right around the 200-day moving average. And then here we are, the last quadruple witching marked the close, marked the low. On the Monday we went down, and Tuesday we started our climb out of the hole. So these quadruple witchings were pretty important. There were also Fed meetings that coincided with these. We'll see that on the next chart. But here we are sitting around the 200-day moving average. And again, with quadruple witching on the weekend, I think it's an important place to watch. We haven't seen a big acceleration in selling this week, so that was the one real positive. But obviously this week with quadruple witching, we'll see a lot more volume. Okay, Fed meeting. And you could just see, by the way, on these charts, if you go through, here's the March quadruple witching, the June quadruple witching, the September, and the December. So these things soar on quadruple witching, and it's just a good place to pay attention. Okay, so the thing I want to note on this chart is right after we have quadruple witching on Friday, we have the Fed meeting Tuesday and Wednesday of the week following. All of those quadruple witchings coincide with the Fed meeting very close. So the December meeting, here was the Fed meeting, and of course we sold off almost 10% from the Fed meeting, 25.75 to 23.50. It was a pretty big hammer down. And then the Fed meeting marked the top in November, and the Fed meeting in September was, a couple of days after quadruple witching, but right between the two peaks, and it was only a few more days, and this rolled over again. Way back last January when the market topped, it was the Fed meeting as well. So these Fed meetings are having a big effect on the market lately, not just uphill all the way. But the other thing we've got is quadruple witching. And again, those big reversal dates are important. So I would not go get popcorn this week. I think it's pretty important to sit and watch the movie. The S&P 500, here we are sitting here at 0.42%. So over the last month, we're still up 0.5%. For the year-to-date performance, what we see here, we've pulled back a couple, so we're at 9.4, but we've definitely broken, I'll call it the 2-month uptrend if you want to be very tight to the line. And if we just extended this back into 2018, we haven't gained any ground from 2018. So we're pretty much, here's the start of 2018. I guess we're up 2% since then. So kind of right back to where we were a year and a half ago. Lots of gyrations in the market, but we're just trying to get through this area up here. So be aware of that. And again, we had a big move off the low here from late December that came up in here, and then the stock market pulled back one day and then went on a good run. So one of the things I'm looking at, this just looks to me like a wave 1, wave 2, wave 3, wave 4, and maybe we get a little wave 5 up here. Don't have that. I am no Elliottician, but just that kind of a move wouldn't surprise me. Anyway, that's another whole subject, and we're not going to get into Elliott wave analysis today. We've had these lines on the charts for a long time now, but what you can see is this was level 2800, 7600, 1600. On the TSX, it was 16,000 that we closed out on Friday. Pretty important levels on the chart, same idea. All of them are major support and resistance levels, and so far they're resistance. Now again, 1 week doesn't make a major market meltdown, so we had that back here in 2018. We had the huge pullback, and then we ran on a rip for 5 more weeks. So not diminish in any way the price action that happened last week. It's a cautionary situation. We had the same in June, and then the market continued to rally. So let's watch really hard to see what the market has got in store for us next week. But there's a lot of reasons for us to fail here in the big picture, as well as there is to go higher. This is an interesting chart. So we fell 20.3%. We rallied exactly 20%. And so now the market seems to be pulling back. We're just below the 200-day. And there's some support down here at 26.25, which would be the previous lows from November and December. And there's a little bit of support at 26.80. So 26.80 and 26.25 are the levels to watch if we start to continue to break down. I think this 50-day moving average just being at this level here bodes well for us. The McClellan oscillator, as I mentioned, was way down at the bottom, so it wouldn't surprise me that we try to rally this week. I think the real question, keep watching that advanced decline line, and if it can't keep pushing higher, so on days where the market rallies but the advanced decline line doesn't, that would be the type of weakness that I would be looking for. Okay. Moving right along, distribution days on the NASDAQ, we've had 4. What does that mean? So what we want to count are the number of days where we had higher volume on a red candle. So one was late February, then we had another one 2 days later. And then we had another one here, 3, and another one here, 4. Friday was not higher volume, even though we had a down day. So we had a down day because we closed below the prior day, but we rallied all day long, so the market wasn't selling into the rally. However, days like this one right in here, where we closed slightly lower, so it makes it a red day on higher volume. So that's a distribution day, but normally you'd want to see I had the wrong day there. That was on lower volume. The point I want to make is usually you want to see a bigger price change on a distribution day, but just volume wise, we're starting to have 4 days that were down days that are on higher volume. Definitely says caution, and normally I think the Investors Business Daily, they continually count distribution days, but normally they would pick something like 6 before they would move to marketing correction. So here's the NASDAQ weekly, and again, one of the primary reasons that I am so concerned is my PPO reading. And again, PPO going below 0 for the first time suggests you're near the end of the rally, and the next rally could be a major last kind of high. It'll either be a higher high, a lower high, or at the previous high. But it's a place to really be focused and make sure. Now, again, it could rally for 3 more weeks and then die. But when you go below 0, it's a critical place for me to watch. And as an example, back in 2015, went below 0, got up, spent almost 2 months up here trying to break above this prior high and then rolled down. We've only been up here for a couple of weeks. So pretty important to pay attention to, but we got a lower high on the histogram this week. And, it's not always very friendly where if the market wants to break down and starts to suddenly bolt quickly, this is kind of the level you would see it at. And one of the things that I find is when you're When the PPO is below zero, that's when you really get the quick acceleration down. So us rolling over right at the zero level, literally, we are 0.038. If it was to roll over right here, right now, this would really kind of tell us that we do have a bigger bear market in store. So watching attentively. This is the New York Composite, and 1 week does not make a month on a monthly chart, but it is the end of the week, so we'll consider it. Again, the big thing we want to look for is what's the trend. And so far the trend on the New York Composite is lower highs and lower lows, so February was still a lower high. And if March ends up not getting back through February's high of 12.6, then we would end up really being concerned, because now we're starting to see lower momentum, lower highs on a monthly chart. That would be concerning. The next chart is just a zoom in on that. So far we've got an inside month where we're lower than the previous high and higher than the previous low. Waiting to see what goes on here. The last inside month was in November, and then obviously December was a bit of a train wreck there. So really concerning. And the other thing that you can look for is inside months typically are market reversal months. Something, not always, but usually it's a good indication that the market's in indecision. So in an uptrend, you usually find it's a higher high and a higher low, almost all the way up. Anyway, at this point, it's indecision early in the month. Russell, lots going on here. Last week, I pointed out that March 1st, watching to see if the Russell rolls over here and starts underperforming. Sure enough, bing, down it goes. Down goes the Russell hard, failing right at the 40-week moving average. Nothing good about that. Look at where the PPO is rolling over below zero. So this just really adds to the level of caution I have. And there's not a lot of people. I don't think I know anybody else who refers to the PPO like I refer to the PPO. So maybe I'm the only cowboy who reads it that way. But I think the PPO is a momentum indicator. When your momentum indicator is below zero and rolling over, that's a really big deal to me. So anyway, just keep it in mind. I think it's one of the big clues that we get from the PPO, and you can make your own decision on it. But I think it's a very valuable tool. So when this PPO trend line broke, that was a pretty important level. It was making lower highs over and over again here, and then all of a sudden just really broke down. So we did that. Now, like just in every bull market, look at right here, you back test the 40-week moving average and fall again. So here we are back testing the 40-week, and it sure wasn't a great place for us to fall back. Now in this case, it fell back for 1 week, rallied, and then fell back down hard again for another couple of weeks. The main point that I want to make today, just the main point, is that we're at a critical inflection point on a really big picture scale, and what we need to be aware of is that the market could move significantly both ways, and the previous uphill run we had was great. The only thing is that doesn't usually continue unobstructed. And more importantly is this left shoulder head, right shoulder sort of structure, and you're either below zero or just failing near zero as the market does that. And we saw the same thing back here, left shoulder head, right shoulder, failing below zero, rolls down really, really hard. Lots of clues here. I think we need to pay attention closely. And I have very good technical friends that, well, I have very good friends that are technicians, and they're very good technicians, and they are so bullish on the big breadth that we have seen. I fully understand that. I'm telling you that the charts are also important. Just taking raw data and the fact that these are rolling over, I think there's more concerns with the rest of the world. So that's why I'm probably more concerned than some of the other people you're hearing from. So the TSX stalling right at these levels here, I mentioned it already, but this is not good. I pointed it out last week that we were already getting a double hump on this momentum, so I'm expecting a roll down, sure enough. It's held in really well so far. I did mention that the Canadian RRSP season ends on March 1 or 2, so normally what you find is a lot of people are putting money into the RRSPs, and the banks are reinvesting those funds, so that helps hold the market up in a downtrend. But don't be fooled. Last year it couldn't help. Don't be fooled here. This is just a really critical level, and maybe it rotates up from here, but it's not a place to be overly optimistic. Just watch closely. From an RSI perspective, this is work by Connie Brown and Andrew, his name escapes me, did a lot of work on the RSI, and when it gets below 40, near 30, that would be a bear market signal. After that, it usually fails to get above 60, so here we are trying to get above 60 right now. If we got above 70 and started to tag a new bull market, that would be bullish. The real question is, if it doesn't do that and rolls over right here, that would be as we expect. Again, the PPO making dipping below zero, went up, came back down, got below zero again, even farther, rallied back up. Momentum was even lower than the prior one. We spent 1 week above the previous highs and then started to pull down from there. We have a downtrend. We break out of the downtrend from well below zero, rally back up, and here we are at zero, and the momentum is clearly stalling. We've got 3 histograms in a row here at roughly the same height. And what we can see is this is the 1-year anniversary of where we actually got the bear market signal back from last year on the RSI. So this move down here. And looking at that, just seeing this big stall level right here where we've spent 3 weeks going sideways, we still have a big downtrend on relative strength. Lots of reasons to pay attention here. Shanghai Composite, I already mentioned the big fail there, so we're going to just move on. The Nikkei, this chart's really interesting. So a couple weeks ago, it got up to the former support and resistance and pulled down hard for a couple of days and then took off to the upside and ran up all the way to the underside of the 200. My big concern here is the relative strength in the Nikkei is starting to make new lows. And this new low is very bearish. We actually got a PPO cross, relatively speaking, just above zero. We'll see if there's any new momentum in this. But if the Nikkei, after getting up to the middle of this big trading area, fails right here, hugely critical. And typically a topping pattern that we would not want to see. And so maybe I should just spend 1 more minute here. So we get this push, we get a pullback, and we create support. We go back up and we're struggling to get through, and then finally we break out. And you can see we spend almost 2 weeks of enthusiasm. We get up and we get to the prior high, and we push above it for 1 or 2 days, can't hold it. And literally we start gapping down and away. And look at, there's a gap in here, 1, 2, 3. This is a gap up, then a gap down, 4 gaps down, 5 gaps down within 2 or 3 weeks, like just a huge move. So all of a sudden when you fail at these double tops, it's meaningful. And the problem we have here, of course, is the 21.9, 21.9, right at the 200-day and starting to fail. And we had a gap down on Wednesday to Thursday, then Thursday to Friday. And now we're trying to hold at this major support level again. These are real problems that we're facing. And again, here we never did get the sell signal because the next day it turned and bounced back up. Here we've already got a sell signal. So my suggestion would be to, these markets are really tricky here. This is a funny one. The US dollar broke out and closed at new 20-month closing highs. That's a big deal. The second thing is I had this rolled over as a potential head and shoulders. I have now just stretched it up to say, what do you want to do here? But, it's this declining PPO that I've been watching closely, and we did not quite get a signal. Look how close we were. But we did not quite get a signal that this is going to give us a bullish cross. But if this started to turn up right here, that would be such a big deal. And again, if the US dollar stays above 97.50, that is adds to volatility in a big way, is my interpretation of that. And you can read that in this article that I wrote under the Don't Ignore This Chart article list, when this currency chart breaks out, and it's all about the US dollar. So I'm not going to cover it in today's video as much, but I do want to talk about some of the other currencies because I talked about the euro or the US dollar mostly in that one. This is Martin King Pring Special K. It's breaking out to the upside here, suggesting the dollar wants to go higher. Another US dollar chart. Here's the euro. And what we see on the euro, looking down here in the zoom panel, is we actually made it. We made a lower low going back for 20 months or maybe even more. And this lower low was a big deal. We got down to 112.25 and closed right in that range. But we closed clearly below, you know, the lower 1, 2, 3, 4 months in here of even price action. And with this little dip down here, probably back in October, it was kind of the last gasp that we closed at. And so this is a significant closing low, not just to close below previous closes, but even before closing below all of the other price action going back that far. We saw this in 2017 where it dipped down, just held here after breaking support, and then that was a good rally point. I don't know that we're going to get that here, and I'll explain why as we go through these charts. But it's not just the euro, it's a lot of other charts that look sick. And so here's the real concern is if this is going to start break down meaningfully, that pushes the US dollar higher. This is the euro zoomed in, so a daily chart, and you can see this little kick down below. Friday was an inside day, so a huge down move. You know, no surprise that it needed to pause after 5 days down in a row. But the real question here is, you know, does it has any bounce momentum? And again, we're getting to the very narrow edge of this wedge. One of the things to think about is if this breakout or breakdown fails and you start to break out above to the top side, usually a breakdown that reverses quickly is what's called a failed breakdown, and those have above average moves the other direction. So then in that case, we'd expect the dollar to drop and the euro to soar. We're about to find that out all through next week, especially with the big momentum things coming up that I mentioned, quadruple witching and the Fed meetings. So XEU, again, just on a daily chart, we're breaking the uptrend here in the PPO. This is not comforting for me at all. Okay, I'm moving fairly slow today. I could probably do a 4-hour show today. There's just so many charts that are interesting. But this Swedish krona told us that this was breaking down a few weeks ago and continues to tell us to expect lower lows. The the British pound struggling at the 65-week moving average, so watching closely. PPO right at 0. If this was to roll over right here, that too would be bearish. So focused on that, and you can just see this topping structure sitting on the London stock market. Okay, so here's British pound zoomed in just on the last few days here on a daily chart. We're testing the 6-month highs here. We got a brief breakout, fail, and moves the other way. So again, as I just mentioned, you know, one of Martin's favorite comments is when a breakout fails, it has an above average move the other way. And so that's kind of what I'm expecting. And here we had negative divergence, so less momentum on this high than we had on the prior high. That tells me that we're probably going quite a bit lower. So the pound breaking down, the euro breaking down, Swedish krona kind of telling us the euro wants to break lower. All of those things add up to me to expect the dollar to break higher. Now here's the Japanese yen. It made a lower low and a lower high this week in the Zoom panel. We got an actual cross here to the downside on momentum. We're right at the 0 level. So if this turns and accelerates from here, it's a place that we would expect. If that was to happen, that's a big deal. Obviously, we got a big 6-year uptrend going here. If this starts to fail now, goes below 0, I would actually expect it to pick up speed if the US dollar starts to find strength against everything else. And if that started to run, I expect more weakness in commodities. This is gold here, and if gold was to start rolling over, big deal. And here we can see the Nikkei up at the top, major horizontal support and resistance level at 20,000, and a small uptrend line can be drawn here. I think I have a chart in here that we broke through that this week. So here's the XJY. Again, same chart, just different. This is displayed differently here. But look at this support level at 89. We want to see if that holds or if it falls right back down to this big uptrend line. Good question. Anyway, so the yen in the PPO giving us the sell signal here today suggests to me that it wants to go lower and the US dollar higher. So here's the uptrend on the Nikkei, and I guess at this point we're still holding it. We haven't broken it, and we're really testing this horizontal support and resistance going back a year. So we've come down below. We try to rally above, fail. That fail signal is a pretty big deal, especially on a lower high. So watching closely. And the yen on Friday gapped up, tried to go higher, closed on the low of the days after failing to push higher. That's a selling tail to me and wants to go lower. Okay, Canadian dollar, same issue, breaking down into the bottom corner here. Lost almost a penny this week, so a big deal. And we had a downslope in momentum, and it looks like it's rolling over below zero. Again, that increases the odds to me that we're going to move down. On a daily basis, this chart is breaking below the 65-day moving average. That's a problem. It consolidated in here for 3 days, so maybe it's just oil holding up in here. I guess that's the real question. Are we going to make a higher low and this is the place to buy? I don't get that feeling yet, but we'll keep watching. Anyway, I mentioned that this in last week's article, the weekly market review, I put arrows on these charts and talked about how the market inflects at all of these major tops touching this line. And here we are right after touching, and the market's been going lower. So want to be concerned about that for sure. Aussie dollar. What we see on the Aussie dollar, well, it's trying to hold a 4-year support level. We've got a little bit of room down here, 1 or 2 more pennies, but this is pretty critical, and we're clearly testing this 6-month level. To me, this is a continuation pattern lower, and I would expect we go down from here. The PPO hasn't quite given a cross signal yet, so we'll pay attention and watch. Maybe it bounces from here. You got higher lows here, flat lows here, so positive divergence. If this rolls over below zero, that's very bearish for commodities as well. Aussie on the daily tried to rally up a little bit on Friday. Still got this gap to close here. I'm not that bullish on any of these based on the close of the US dollar. LIBOR, I think this is an important chart just from momentum, putting in this lower momentum roughly 6 or 9 months after the previous peak. And here you can see prices doing the opposite. So this change in momentum is something I'm watching quite closely. If this starts to go below zero, I expect this to cross and be the first meaningful cross since 2014, where it crossed up. Now we'd see this interbank borrowing rate roll down. Junk bonds. This rolled over, broke out for a couple of days, got above the 200-day moving average, failed, 40-week moving average, failed, and is now rolling over. Again, a failed breakout to the upside probably gives you an above-average move to the downside. And, it's this big bear market sort of structure where you see the quick moves down that we're watching for. So here we've had a quick move, and if this rolls over again, it could be just as easy that we end up with this sort of thing here where it just falls quickly. We're right at the zero level, so if we were expecting a fail, this is about where it should happen. Okay, the Treasury bonds, this is another big one here. Trying to rally, put in higher highs today, or to close the week. And so with that higher high, you're seeing this move to safety. Here's what I'm surprised at. Here's the downtrend for 5 years on this line for momentum. If this starts to break above that line, hugely bullish that this is going higher, not lower. And so people moving into the comfort of yield and away from the stock market. So this is, for me, this momentum indicator in the next week or two is a really big deal. I'm watching this extremely closely, and I would use that as a big clue. LQD, the corporate bond, same thing, got above, rolled over for a week, and then looks like it's ready to keep going. Right at zero, if it was going to fail, that was a big deal. If it's going to keep going, an even bigger deal. The fact that it broke this 3-year downtrend, I think that's huge, and it's moving to the upside. Okay, the 2 year, this chart I spent a whole bunch of time on. There's more in the article I'm writing today, and you'll be able to read that later on under the Canadian Technician. The big thing I talk about is this comparison here, and I added in the US dollar on that chart. Let me just go see if I can get it for you. Ticker cloud. Want to just go grab US dollar, or sorry, dollar UST 2 year. Where are we? Not this one, this one. One more. Okay. So on this chart, what I've done is I put the US dollar down here. And the point is that when the US dollar is going up and this yield is falling, this is a pretty critical place. And you'll notice stock market topped out, PPO had rolled over. Here we got an RSI sell signal. It took a while before the US dollar started to rise. It was falling all through here. But in early 2008, the US dollar started to accelerate higher. And that was when things really fell apart on the yield market, on the stock market, and the US dollar surged. In 2016, we had a condition where we touched the top, so overbought, pulled back. Stock market got weak, right? 2015, 16, came down here. And here we failed. The PPO had given us a sell signal and the US dollar started to soar, but so did the stock market. So we quickly canceled the signal we were looking for, which was a lower stock market. And on the current situation, what we have is an oversold reading that is now starting to come apart. Failing here, staying under this is a monthly chart, under the 10-month moving average, and turning back down again so far. And again, we're early in March. But look at this PPO continuing to decline. And now we have the US dollar surging. So that suggests to me to be very, very cautious. If the US dollar is going to be breaking out to new highs, that this situation lines up to say to me, at least be aware of the potential for this whole thing to be a big major top. The spreads, I don't know why this chart is so small. Let's just blow it back up and save it that way. The big thing on this chart here is last week we started to get a spread improvement where the 30-year was starting to climb, everything was starting to climb, rolled back over, and in a lot of these cases they're starting to make new lows. Oh, I'm in the wrong chart list here, sorry. Let's go back over to the 2-year TLT. BlackRock Muni Fund continues to tell us that the yield wants to go higher, and so it's broken this big long downtrend of 5 years or 7 years. I would not ignore this fact. So this says to me, this wants to go higher. I was really worried here in February, another low volume, so I would expect this to roll over. It's done exactly the opposite. It's surging on the news, so it got to this kind of moment of hesitation, and now it's taking off. That is a big deal. And again, 1 week doesn't make a trend. So we've finally broken above this trend line. Any sort of acceleration on this, I think, is a huge trend change. We'll see the full stochastics. It didn't roll over at 50. It looks like it wants to keep going. That's a big deal. And again, that would make me expect that the bond market's going to continue higher in price, lower in yields. The 10-year, this is a monthly chart, and so far last month we had an inside month. So far this month we've already got an outside on last month's, and we're below the bottom. So I think this topping in the PPO that we got says we're going down, and it's we just paused here and we're on our way. This is the weekly version of that same chart, and we made new 52-week closing lows, and the only week that was lower than that was the December week. So this looks very ominous to me. The 5-year is breaking the uptrend, really a critical spot on the charts. So I'd be very, very concerned if this trend continues where all these yields lower, price higher. That just says people moving into the safety of the bond market. The 2-year chart here, this is just the yearly, and you can see this 3% level we've had marked on here for a while. Watching to see what ends up happening on a yearly basis, but so far nothing. This is the 2-year going back zoomed in closely on a weekly chart, just putting it out as a line chart, you can see that this uptrend was supported by the 10-week moving average all the way through. In November, it started to break lower, and now it seems like we're on our way down. PPO is below zero. We've broken the uptrend. There's just not a whole bunch to fall in love with on that chart. The 30-year. Oh boy, this one, we've broken the downtrend and we oscillated in here. And what you see is that it looks to me like we're going to turn and continue to accelerate higher, which is what I would have expected when we broke this big downtrend on the PPO. So as this happens, really trying to kick this thing up here, and if we get a continued move higher right here, I think this is a really big move and could move all the way back to the other side of the channel. Okay, going in on, this is the zooming in on the last few years, and what we see here is breaking above this 145 level, really, really important. So all of the bond markets give me big caution here. Here's the 10-year, the 30-year yield, and you can see yield going lower, so price going higher. And this, I said it was going to be a battle royale. Well, it has been exactly that since November. And this, so far, it looks like the 40-week is holding everything back. And if this is going to break to new lows, PPO below zero, I would expect big acceleration downward. Okay, I do not have a lot of time left, so the one thing I want to briefly do is just go through the commodities. We won't go through the individual charts, but oil, just rattling around here. I'm actually surprised it hasn't given more back, so that's one positive I see out there. Heating oil and gasoline still holding up above the 10-week moving average, so that should be bullish for the energy area. Corn, agriculture just looks horrific. This corn chart tried to break out to the upside, failing, coming down. It looks like it might even break the 2-year uptrend. Soybean has already broken its 6-month uptrend, and wheat just gave it all up and has now broken the 2-year uptrend. So nothing to be comfortable with there. Gold and silver. Gold had broken out, pulled back to horizontal support, and we're watching. Well, it wasn't a big move higher. We'll just keep watching to see if it's got anything left. Silver is broken out. It could be a back test of the line and head higher. One thing to watch for. We're also trying to find support at this 15.5 level. To tell you the truth, with the dollar and all of the currency charts at where they're at, I have trouble believing that gold can go higher. So that's my fear. Copper, this rolled over. Look at aluminum. This just continues to be in a downtrend. Copper failed right at this horizontal resistance level, so not good there. Livestock is breaking higher. That's one part of agriculture that actually looks a little bit better is livestock. Sugar and coffee, this failed right at the trend line and fell. Coffee continued to scoot lower. Cocoa broke down below the 10-week. Cotton holding, but nothing really important to see there. Medical marijuana, this ETF broke the trend line this week, so I'm a little concerned this rolls over right with the PPO and momentum near zero. To me, that's a very scary level on the chart. Coal, sure enough, failed right at horizontal support and resistance, rolled over back below the 10-week, not good. Steel, the same thing. So these false breakouts just kill us in terms of technical trading, but at least we get out quick when we're wrong. Lithium, same thing, tried to break out of this big downtrend, spent a little while here. Look at that nice big push and gives it right back below the 10-week. And rare earth strategic metals trying to base here has clearly broken the downtrend, but started to give it up again this week with the higher US dollar. Lots to worry about. Anyway, so with all of that, crack and frac both look very weak. So the refiners look like they're going to roll over. Full stochastic starting to break down. So that one really gives me caution. And the unconventional oil producers, this chart looks even weaker. Made a big outside move down below the 10-week this week. And it just looks like it's not able to break higher, rolling over near well under zero. Lots to worry about. Full stochastic not back up to 80, so this looks weak. Anyway, I'm going to wrap it up there. The charts look very weak. The next 2 weeks are hugely contentious for me, but stay safe, hold your stops, and just let them take you out of the market if it happens. Bye-bye.